Now, bond yields, well, they shot up after the credit policy because of the new instrument which Reserve Bank of India had indicated that they would start using it ahead of the India's bond inclusion. But post the inflation number, 5.6, I like the ring of inflation when it is always below 6. And I think bond markets are also liking the ring of inflation when it is at 5.6 ahead of the festival season. And B Prasanna, I'm sure, will also like the ring of inflation when it is below 6. So Prasanna, good morning. Thank you for joining us. I like the ring when I say every time inflation 6% ke niche. Now let's understand that inflation number which has come yesterday below 6%. Should we take heart from that? Should we assume that this is going to be more than just a mathematical and a transient phase?
Hi, good morning, Nikanj, and thanks for having me. Yes, it is true that it was actually a double delight for India yesterday when headline inflation came down to closer to 5%, and even the IIP, there was an upside in the numbers that came out. As far as inflation is concerned, yes, you're right. We can take heart from the fact that not only the headline inflation, but even the core inflation has actually fallen. Core inflation is something that RBI tracks, excluding food and fuel, which are a little bit more volatile. So getting a number closer to 4.5% indicates that well and truly the generalized inflation pressures are on the way down. And on the food inflation side, very clearly what we saw in the last 2 months was a very temporary spike in inflation led by vegetables like tomatoes and all that. And there has been a real fast reversal in those prices. Despite monsoon not really being as normal as it normally is. So from that perspective, I think there have been very good price management from the government, and RBI has also done its bit in terms of controlling generalized inflation pressures. So all in all, I think positive inflation data. Not that the market did not expect, the market or the analyst community expected it to come down to 5.2, but coming to close to 5%, I think was slightly better than expected.
Okay, now with inflation at 5% and the fact that festival season starts now, do you think this inflation print could be challenged? Because the monsoon effect is something which now will be visible going forward. And now that festival season is round the corner, do you think 5% could come back mathematically above 6.5 again?
So I think, Nikunj, the way to look at inflation is to, look at it from both what is happening to the sequential inflation, which is the month-on-month numbers, and what is happening to the year-on-year inflation, which in turn includes the base effect. So in all perspectives, I think the near-term inflation, which is the October inflation that we would see, is possibly going to, which we will see in November, will possibly be closer to the 4.5% kind of levels, which means slightly lower than what we are seeing even now. But I think that will be possibly the best inflation that you would see over the next 4-5 months. And after that, sequentially, we'll probably see it going back to 5% handle, hopefully not the 6% handle. And after that, we'll see over the next 1 year inflation coming down to the 4% handle in Q2 of FY25. I think the story is that broadly inflation pressures are well contained, and the spike that we saw, which led to a lot of fears that it's going out of control, has turned out to be very, very temporary. And I think back to the long-term trajectory of inflation inching towards the 4% mark. But bear in mind, we still don't see actual 4% mark getting hit over the next 1 year.
Okay. Jayesh Mehta, let's talk about bond yields specifically. Last week was a bit of a scare when bond yields after the credit policy shot up. And now post-inflation, bond yields have not really, can bond yields come back to normal levels post the inflation data, Jayesh?
Yeah, I think currently what we are seeing is, if you really look at it, what was the general public poll expectation from the RBI on the policy, right? It was supposed to be a hawkish pause, right? And that's what RBI actually did, right? So at that point of time, you didn't do any action on the hawkish side, but you did make a couple of announcements, that is, 4 is the target, and we might do OMO sales for liquidity purpose. Very well clarified in the press conference also. But that also depend a lot on where US yields were, right? So I think that where the US yields were, that's where the market was a little heavy, and they did consider that. And that's where we spiked up. I think it will still now track US yields tomorrow. It doesn't look like, but if hypothetically, if US yields drop down, then definitely we'll see some relief there on the bond side. But as of right now, yes, the market is kind of going, and typically we have this, this particular quarter, October, November, December, from a demand perspective, also a little bit weaker historically. And that's where people are just keeping off the little bit of the position. So I think I would look at it not really, coming up very quickly unless US yield comes down, or maybe we see much softer inflation print, which doesn't look like coming very quickly.
Prasanna, now let's look at the global macros here. We've talked about vegetable prices, bindi, tomato, that's all fine. But globally, we are also talking about a Fed which is hawkish. We are looking at US economy which was supposed to hit a soft landing patch. It is unlikely to hit that. And then you got China which was supposed to recover, has not recovered. Europe was supposed to slip into recession, which it has not slipped. So they are looking at a lot of moving parts, aren't we, Prasanna?
No, I mean, that's all in the game, isn't it? I mean, that's why markets are markets. I mean, there are a lot of moving parts. The thing on Fed and the US is that the data has been continuously coming on the stronger side. And yesterday's inflation print from the US also clearly indicated that it's still not yet slowing down to the level that policymakers will be interested. But what is also interesting is that the irony is that the entire bond yield move that we have seen over the last 2 weeks or so is also a reflection of the kind of fiscal pressures that are prevalent in the US, with the US government, spending quite a bit, and the fiscal deficit being at a much, much higher level than, what was common in pre-COVID levels. So it was actually inflation which was led a lot of it by fiscal policy. But unfortunately, it was monetary policy which was taking on the full might of controlling inflation. And in kind of an ironical twist, it is now the fiscal which has again come back in terms of borrowing program to lift the bond yields up, which in turn is actually helping the Fed with the financial conditions index tightening. So it's quite possible that the Fed might not need to go and do the next 1 or 2 hikes that they would have otherwise probably done in order to control inflation. So what I'm broadly saying is that the financial conditions index has tightened substantially, even though the Fed has not done much over the last 1 or 2 months. So we do expect the base case scenario for the Fed to not hike anymore. But having said that, I mean, like you said, it's always a moving part. Growth is always, we need to look at data at all points of time. The labor market is not really slowed down in the US. The rebalancing which the Fed has been trying to engineer has still not happened. And unless that happens, you can't really get comfort from a long-term inflation perspective. So all in all, yeah, interesting times continue. We need to keep looking at data. But having said all of that, I still want to, kind of bet that Fed is kind of, done its peak in terms of rate hikes, and maybe sometime in the middle of next financial year, calendar year, they might start looking at the initial cut.
Jayesh Mehta, just to draw your attention back to the current 10-year, which is at 7.31 instead of 7.29. So my point is that if inflation is down, what I've read in financial books is that if inflation goes down and if it is better than expected, yield should actually come down. ये तो उल्टा हो रहा है.
So, is that to me?
Yes. I ask you all the difficult questions now.
So let us put it slightly differently also. When we had index inclusion, right, the yields actually went higher, right? That guys also must be surprised that we have never seen anything like this. Like we got India into index inclusion, and that day, of course, it came off and closed the day at higher than the previous day. So that was kind of priced in. I think as Prasanna also said earlier, market was expecting 5.2 inflation. But it's again, as I'm saying right now, more than India macro, it is kind of tracking the US macro to an extent. Little bit of relief there today is on the OIS. There's no much change. So that's like people are thinking that like it's a relief kind of a situation. So from that perspective, at this juncture, people are on the lookout. Of course, if we didn't have index inclusion, even though nothing changes on our macro, we would be much higher in terms of yield at this juncture because of what's happening globally. Now, of course, it's again a mindset issue. It's over a period of time. People will know. But I cannot resist, Nikunj, what Prasanna was talking about, monetary and fiscal. So I can lightly say that US is going through what we went through in 2009 to 2013, where monetary was trying to do certain things and fiscal was doing something differently on the inflation side of it.
All right, gentlemen. Thank you very much. By the way, which one of you is going for the cricket match tomorrow?
Not me.
Neither.
we have a lot of excitement in the markets, right?
Arey, come on. India, Pakistan and bond market, come on. India, Pakistan is more exciting. Jayesh bhai, be realistic. Be realistic.
I'm not really into cricket as such. So for me,
Nikon, show the match live on ET now. We'll watch ET now.
That.
No. See, we will keep the screen full with exciting. So Saturday afternoon, do tune in. I'm sure I can promise you the cricket update would be there.
Okay.
Enjoy your day and enjoy the rest of the week. Thank you very much, gentlemen. And always a pleasure to have you and to get your thoughts on which way the bond market and which way the macros in the world are moving.